with regard to mark to market calculation and methodology for the trading member, we will try to just take a small example and see how the mark to market margin calculation can be arrived for a particular trading member for various settlements. Now if you see in this particular example, the MTM computation, that is the calculation, can be used or followed in a particular manner. Let us see what has happened for various clients of a particular trading member. Now let us take client A. Let us say he has transacted in security X and security Y. On T minus 1 day, the MTM profit, that is the position which is in a profit of 800 rupees on T minus 1 day, and for security Y he is having a loss of minus 500. Now what is this 500? This is a MTM loss for this particular position what client A is holding with him. Now the net position he has is 300 rupees, he is in profit. Now on T day, that is the next following day, when he is holding these both securities, that is security X and security Y, he has holding position for the next following day also. Then due to change in the price of that securities, he has in a further positive mode or further profit of 300 rupees on security X, and he has gone into a further loss of minus 1200 on T day. So if I see the net position for client A on T day, it works out to minus 900. So what is the net loss, that is the notional loss or the mark to market loss, is minus 900. So on T minus 1 day there is no MTM arrival or MTM calculated which can be imposed on client A. Only on T day there will be a MTM loss of minus 900 which the client will have to pay to the trading member, and this trading member will in turn pay to the exchange. So the MTM which is computed for client A for this particular trading member is 900 rupees for T day. So that means he will be paying this 900 rupees the following day, that is next to the T day period. Now let us take client B. He has traded in security Z and security W. For T minus 1 day there is a profit of 700 rupees on the position of security Z, and there is a loss of minus 1000 on security W. So the net MTM that comes to this particular T minus 1 day position works out to minus 300. That means client B is supposed to pay 300 rupees is the notional loss or the book loss, the mark to market loss on his positions for T minus 1 day. Now if he carries forward the same positions to the next day, that is the T day, he has got into a loss of minus 400 on security Z and profit of 800 rupees on security W. So there is a net profit of 400 rupees on the two positions for client B. So what is the mark to market this particular client B has to pay? It is minus 300. This constitutes only for the T minus 1 day which he has to pay for the following next transaction day. So in effect the client B has to pay minus 300 after T minus 1 day, that is the next day to T minus 1 day. Now for the T day transaction the net position is still in profit, so he need not pay any MTM for the positions he is carrying forward after T day also. Now let us take client C of the same trading member. This client C has traded in security X and security Z. For T minus 1 day there is a profit of 1000 rupees after the position is taken and the market has closed. Then for security Z, there is a loss of minus 1500 after he has taken the position during the market hours, but since the market price would have gone against his position, he is having a net book loss or loss of 1500 rupees on the position he has taken on that particular day. So what is the net loss? 1000 rupees profit on security X and 1500 rupees net loss on security Z. So in effect, he is in a net loss of minus 500, which constitutes the MTM required for client C on his net positions, the total positions, which he has to pay the following day before the market starts. Now for the same client, if we go to the next day, that is the T day, if you see on security X, 500 is the profit on his position and minus 800 is the loss for his position on security Z. So if I take the net position of this particular client, it comes to minus 300. So that means he has gone into a further loss of minus 300 on the following day also. So this minus 300 he needs to once again pay the following day after the T day. So if I take total MTM, this particular client C has to pay is minus 500 and minus 300. So totally the MTM is minus 800. So 800 rupees he will have to pay continuously as the position gets into a loss if the market price of that securities keep changing. So minus 500 which he has paid the following day and minus 300 on the next second day because the positions have gone into further loss. So if I take 2 days positions, net MTM he has paid is 800 rupees, which he has to pay to the trading member, and the trading member in turn has to pay to the exchange. Now let's take client D. This client, he has took position in security Y and security R. On T minus 1 day, the profit on security Y has been 700 and on security R the loss has been 300 rupees on his position after the market closed and the values of these securities has changed. Now what is the net profit? That is 400 rupees on T minus 1 day after market closes. So this particular client D need not pay any MTM because his positions are actually improved. So he is in a net profit on his positions. So there is no MTM situation for client D on T minus 1 day. Now coming to the following day, that is the T day, the next day, the security Y has gone into a loss of 200 because his position has changed because of the change in the market price of that particular security. Whereas on security R, it has become 800 because of the change in the market price on the T day. So the net profit still remains 600. So totally he is in a profit of 400 for T minus 1 day and 600 for T day. Totally he is in a profit of 1000 rupees for the 2 days transactions or the transaction which he has made and he carried forward for next 2 days. Now what is happening? If you see the total statement, for client A there is a MTM for 2 days which totals to 900, and for client B the MTM totals to 300 for the 2 days, and client C the MTM totals to minus 800. For client D there is no MTM. So if I take the total MTM that has to be paid by the trading member to the exchange is 2000 rupees. This 2000 rupees totals the MTM for 2 different trading days, that is, or 2 different days, T minus 1 and T day. So we have quoted what is the total amount which the trading member would have paid to the exchange is 2000 rupees. This is how the MTM is calculated. However, as per the settlement date, the T minus 1 day what is the exact total MTM this trading member has to pay will have to be paid separately, and for T day also what is the MTM he has to pay to the exchange will have to be calculated separately and paid accordingly. When we total these two amounts, it is coming to 2000 rupees. That means in the last 2 days the trading member would have paid totally 2000 rupees MTM towards his clients A, B, C and D based on the transactions those clients have done and the clients positions, how they have gone into a negative situation because of the change in the market price of those respective securities. So this is an excellent example which has been given, which will explain you how the MTM arises. Now for client A, his MTM profit or loss would be calculated separately for his positions on T minus 1 day and for T day. So these constitutes two different rolling settlements. For the same day positions of the client, his losses in some securities can be set off or netted against the profit of some other securities which that particular client would have taken. This is what we have done in this particular example. Thus, we would arrive at MTM loss or MTM profit figures of the two different days, that is T and T minus 1 day. These two figures cannot be netted. That is, if there is a loss on T minus 1 day and there is a loss of T day or profit on T day, both will not be adjusted. Both will not be taken into account in one go. Both will be treated separately and accordingly the MTM will be paid on two different settlement periods by the trading member to the exchanges. Any loss will have to be collected and same will not be set off against profits arising out of the positions of the next day or the other day. That means if there is a loss today in the positions, this cannot be set off against the profit of tomorrow in case it arises, and the balance has to be paid. That case doesn't arise here. If there is a loss on today, the loss for that extent MTM has to be paid tomorrow, and if there is a profit tomorrow, it will not be adjusted against this loss at all. Thus, as stated, MTM profits and MTM losses would be computed for each of the clients, client A, client B, client C, clients D. As regards collection of these margins from the broker, the MTM would be grossed across each and every client and computed total. This is how it is done, and that is no set off of loss of one client with the profit of another client also will not be done. That means if client A is in a loss of 300 and client B is in a profit of 500 on T minus 1 day, it will not be netted. That is, loss of 300 of client A and profit of 500 of client B will not be adjusted. So 300 will be paid separately. It will not be adjusted against the profit position of client B of 500, and the balance 200 which is arrived is not considered for payment for MTM. This is the important aspect. Now, in other words, only the losses will be added to give the total MTM loss. That is the loss of client A, the loss of client B, the loss of client C will be taken together to arrive at the total MTM loss which has to be paid by the trading member to the exchange will be computed. If there is a profit in another client, this loss will not be adjusted against the profit of the other client. This is very important. The broker in this particular case, as we have seen, has to pay an MTM of 2000 against his 4 clients A, B, C and D. Now, we have discussed the second aspect of this particular margins, that is mark to market. Now we are coming to the third aspect of margins, that is extreme loss margin. The extreme loss margin for any security is higher of 5% or 1.5 times standard deviation of daily logarithmic returns of the security price in the last 6 months. So, we take 5% of this particular logarithmic returns, or we take 1.5 times the standard deviation of the logarithmic returns of a security on the last 6 months transaction basis, and then we consider the higher one out of these two as the extreme loss margin. This computation is done at the end of each month by taking the price data on a rolling basis for the past 6 months, and then the resulting value is applicable for the whole of next month. That means by the beginning of the next month we will come to know what is the extreme loss margin for a security based on this criteria, so that that extreme loss margin will be applicable for the whole of the next month. This is dependent upon the activity of the stock in the last 6 months, and the daily logarithmic returns and the standard deviations and certain percentages are taken into account to arrive at this particular extreme loss margin. The extreme loss margin is collected, adjusted against the total liquid assets of the member on a real time basis. That is, during market hours, this extreme loss margin, if reached for that particular security, it will be accounted on real time basis, and that amount will be collected from the amounts that are available with the exchange on behalf of the trading member. So, if a trading member amount liquid assets which are lying at the security exchange, that is the stock exchange, there they will keep track of this extreme loss margin of this particular transactions of the trading member and keep track and accordingly use the liquid assets of that particular trading member for the security positions they are taking. The extreme loss margin is collected on gross open positions of the member. The gross open position for this purpose would mean the gross of all net positions across all of his clients of this particular trading member, including his proprietary positions. So, his positions, his client's positions, both will be used to arrive at the gross net positions for the purpose of extreme loss margins on the securities which they are transacting. There would be no netting of positions across different settlements. So, for today's actions of the securities or today's transactions of the securities, the extreme loss margin will be applied and accordingly debited to the trading member's account on the liquid assets available. It will not be adjusted against the extreme loss margins or profits for the next settlement day or the next day transactions. So, today's positions, today's extreme loss margins are calculated, accordingly adjusted from the liquid assets of the trading member. Again, tomorrow if further transactions are done by the trading member or through or for his proprietary or for his clients, then extreme loss margins for those transactions are separately computed, separately applied and separately accounted against the liquid assets of this particular trading member with the exchange. Fine. The extreme loss margin is released on completion of pay-in of the settlement. So, this margin will be released by the exchange once the amount has been paid after the transactions are completed and the amount totally has been received by the exchange from the trading member. Now, we have seen for 3 different type of margins: value at risk margin, mark to market margin, and we have also seen what is extreme loss margin, which is computed on real time basis. Mark to market margin is generally computed after the market closes, so that we can arrive at what is the loss positions of the contracts or positions the clients and the proprietary accounts which have taken for that respective trading member. Now, we are coming to a concept called cross margining. Now, this is actually the margining adjustments or setting off against the positions what a client takes or the trading member proprietary account takes pertaining to a particular trading member. That means a person takes a position in one segment and also takes another position of similar security in another segment, then there will be a margining adjustments which will be done, which is called cross margining. Let us try to get into details about this particular cross margining, how it arises and how they are computed. An offsetting position for a client in different segment has lower risk as loss on one position is offset by profit on another position. An example for an offsetting position can be a buy position of 100 units or 100 shares in security A in capital market segment and short position of 100 in stock futures in the same security A in the derivative segment. So, a person is buying 100 units, 100 shares in capital market of security A and shorting 100 shares in derivative segment of the same security. Then what happens? If the price goes up, then he is getting profit in the security A for 100 shares he bought in cash segment, and there will be a loss in the 100 shares short position, that is sell position, which he has taken in a derivative segment of the same security. In such case, what happens? The profit in capital market position of same security and the loss in the derivative segment of the sell position of same security A will almost match. In such cases, what happens? The cross margining will reduce the actual margin that has to be paid by the trading member. Now, as the risk of the offsetting position is lower, the margin requirement for the combined position has to be lower, which is considered as cross margining. The benefit of cross margining is provided on the following offsetting positions only. What are these positions? There are totally 3 situations which can arise for cross margining. 1. Index futures and constituent stock futures for same expiry in F&O segment. So, a person taking a position in index futures, let us say he has taken a long position in index futures and he is taking a short position on the stock futures pertaining to this particular index in the derivative segment. So, when we take such positions, when index goes up, he will have profit in that, and short position he has taken in the stock futures pertaining to that particular index will be getting into loss. So, the net profit of index future and the loss in the stock future will be netted, and only the differential will be considered for margin payment by the trading member. The second category, positions taken on index futures and constituent stock position in cash segment. Here, instead of taking a short position in the future segment of the constituent stock of the index, he is taking position in the cash segment of the stock constituent of the same index. That means, let us say Nifty is the index, ITC is a component of this particular index. So, he is taking a long position on Nifty and taking a short position on ITC in this particular derivative segment. So, when index goes up, ITC also goes up because ITC is a component in Nifty. So, there will be a loss in ITC and a profit in index future long position. So, both put together, the net loss will be slightly different or slightly less. So, only the differential only will has to be paid by the trading member in the exchange. Now, coming to third category for cross margining, taking position in stock futures in F&O segment and taking positions in the stocks in the cash segment. So, if we consider, let us say BPCL. So, what are we doing in BPCL? We are just replacing the positions from index futures to the stock and the stock futures only.
So here we are not taking into account the index futures. What we are doing is, let us see, there is a cash segment and a future segment. We are taking long position for BPCL in the cash segment and taking a short position or sell position in BPCL future segment. So if BPCL rises, the position in BPCL cash segment will be in profit. Since we took a sell position in future position of BPCL, that price also rises. So we will be coming into a loss in the sell position of BPCL futures. So if I see in net, there will be a nominal loss, because the position in cash will be gaining profit and the sell position in futures will be gaining loss. So when I see the net positions, we will be in a minor loss. So this is called cross margining. The offsetting position in respect of A and B above, that is index futures and stocks or stock futures or constituent stock futures, are computed considering weightage of that particular security in that particular index. A file is provided by NSE on its website nseindia.com, providing minimum number of units of stock and stock futures required to offset position in index futures. The number of units is changed only in case of change in share capital of the constituent security due to corporate action or issue of additional share capital or change in the constituents of that particular index. The cross margining benefits are computed and provided on a real time basis in respect of all existing and confirmed positions. The offsetting positions are margined only to the extent of 25% of all the applicable margins, that is all upfront margins, that is initial margins and exposure margins. Now what happens for margin shortfall? Till now we have seen how margins are calculated and how margins are applied for purpose of payments by the trading members to the exchange. Now when these particular margins are computed based on various transactions, based on transactions of the clients, based on the transactions of the proprietors, based on the transactions that are carried out for each particular settlement period. Now once based on these calculations, once we have arrived at the margin structure to be paid, and if this particular margin, which is an obligation from the trading member side to make the payment, that amount is generally used from the liquid assets of the trading member which is lying with the exchange. Now in spite of the margin which is adjusted from the liquid assets, if there are further margin shortfalls which the trading member may have to pay at a later stage because of the shortfall in the liquid assets with the exchange, there will be certain penalties. That means if the trading member fails to meet the margin requirements, a margin shortfall situation arises. When such margin shortfall situation arises, what happens? Let us try to get into the details. In case of any shortfall in margin, two things can happen. One, the members are not permitted to trade with immediate effect. What can be the next thing? A penalty for margin violation will take place. These are the two things which can happen. Penalty applicable for margin violation is levied on the trading member on a monthly basis based on slabs as per these particular details. Penalty for margin shortfall table 4.7 can be seen on this particular chart. Now we can see the instances. Now we can see the instances of disablement and penalty that will be levied. For the first instance where the shortfall arises, 0.07% per day for the margin shortfall will be charged on the trading member. For the second to fifth instance of disablement, that means after disablement also, if the trading member is not able to fulfill the obligation of margin payment, then what is the penalty that is charged? 0.07% per day for the margin shortfall that is not paid, plus additionally 5,000 per instance from second to fifth instance. That is, if he is not able to pay on second and third day also, 5,000 for second day, 5,000 for third day will be additionally charged by the exchange. For the period 6th to 10th instance of the disablement, then what sort of penalties are levied? 0.07% per day plus 20,000 for second to fifth instance, that is for the next 4 days 20,000 additionally will be charged in addition to 0.07% per day for the shortfall, plus 10,000 per instance from 6th to 10th instance. So for 6th day 10,000 will be charged, for 7th day additionally another 10,000 is charged, for 8th day another 10,000 is charged. In such manner the levy of penalty will be imposed on the trading member. From 11th instance onwards, that means after disablement, the trading member is not able to pay even after or from 11th day, what happens? The penalty will be as given in the table, 0.07% per day, that is the first penalty. In addition to that, 70,000 for second to 10th instance, that is from second day to 10th day, 70,000 in lump sum will be charged, and 10,000 per day from 11th instance onwards it will be charged. Additionally, the member will be referred to disciplinary action committee for suitable action will be done. Now, instances as mentioned above refer to all disablements during market hours in a calendar month. The penal charge of 0.07% per day is applicable on all disablements due to margin violation any time during that particular day. This is how the penalties are levied by the exchange on the trading member if there is any shortfalls taking place from time to time.